Friends, it has been a wonderful journey curating an advisory in the mutual fund space. Many people wonder what is it that differentiates our ithought advisory from others. I'm sure there are many competent advisors. There are different models that are in the marketplace, and there are people who do it themselves as well. So, what is it that we could do differently? Firstly, if we could not do anything differently, I would never have entered this space because I had done 20 years of equity research and investing and done reasonably well and had no reason financial to venture into this space because I was already making enough money, and however much an advisory would grow, it's not going to really move my personal needle. So the motivation was to do something radically different. What's the great need to do something radically different? The first and most important reason is that in every bull market, after the bull market ended, I found that people were investing in financial products in a way in which they could not come back when the markets came back, or there would be a huge lag, and they were making journeys in a way which was not even safe. An example, in 2000, after the crash, people were still buying tech funds hoping that there would be a comeback. The same bounce expectations dominated 2008 as well. When I introspected as to why this is happening, the reason was very self-evident. The entire product space, mutual funds and insurance, ULIPs, were oriented towards benchmarking with indices. And in every bull market, the indices got overloaded with one sector or two sectors which were already overvalued. And as luck would have it, once the market crashed, the fundamentals of that sector did not look as rosy as they looked before the bull market. So imagine you have loaded the indices with a particular sector, and those companies are being continuously bought by the funds. So money is going in the wrong direction, and it continues to go in the wrong direction until these companies leave the benchmark. On the other hand, at the end of every bull run, there would be sectors, teams which are completely ignored, and they did not even participate adequately in the bull run. And most importantly, there is the scope to make a cash call where you find valuations very high and you tell clients, let's go away. This is something that I found did not come so easily to the advisory space. My interest was to create this into a model which is dynamic, which understands risk as they are and not as the indices recognize them. Which means you need to be always ahead of the market and you need to always stay ahead of the market. And by being ahead and staying ahead, you manage risks in a far superior way. It is this concept that we have tested over these years, both in the distribution and in the RIA space. And in the RIA space specifically, we have curated a model where contrarian investing, risk management, forward-looking product research, and portfolio construction come together to do risk management in a very pragmatic manner. In the current cycle, we have added more emphasis on asset allocation. And all this has helped us to demonstrably show that our advisory thinks differently and works differently. Effectively, the consequence of doing this consistently over a long period of time is this becomes cultural to the organization. It becomes endemic to the investment model and it becomes institutionalized. When I say this, it is 2 years since I personally was the advisor because I have moved on to managing a PMS scheme. But today, a very competent team, a very broad based team manages the same ideas and is able to come and demonstrate to me first that they are doing it as best as it should be done. And that essentially is the most satisfying thing for me in this journey with ithought RIA. And that essentially is what ithought RIA stands for and what it will work for. To understand more, a good conversation with one of these young people would give you a clear idea of how an advisory can be run out of the box and yet serve the needs of hundreds of investors, specifically understanding their risk profile, making those choices which are ahead of time, helping them stay in those choices, walking them away from risk when it's the time, and walking them gradually into risk as the economy comes back. As we are now in a negative growth economy, I believe that our ithought RIA will be able to do a better job of navigating these most difficult times of the Indian economy in helping you build a portfolio that will be resilient and will deliver performance when growth returns. I invite you to know more about us, understand our work, and would love to hear your feedback. Thank you for watching this video.